I think welcome everyone for today's session on key learnings from an NFRA orders. And I think we have a very learned faculty, Padmashree, to take us and guide us as to what are the key takeaways and what are the expectation of the regulator, which is NFRA in this case, and how we can take this learning and improve our documentation or also improve our firm governance standards is what can be a key takeaway from this session. And Padmashree is very knowledgeable in this area and very an experienced faculty who would be guiding us today. And thank you, Padmashree, for taking your valuable time today. With this, I would request Yogesh Bhai to introduce Padmashree and then we can start the session. Yeah.
Thank you, Tejas Bhai. Thank you, Padmashree, again for inviting or accepting the invitation from the chambers for delivering this talk. Friends, as Tejas Bhai mentioned, that Padmashree has a lot of experience in this area. So with this, let me briefly introduce her. So Padmashree is a partner with the audit and assurance practice at MSKC and Associates. She operates out of Mumbai office and has over 18 years of extensive experience in practicing audit services across industry verticals of insurance, financial service, and manufacturing. She is also in charge of keeping the audit team well informed of the latest technical development in various statutes and regulations, preparation of certain publications for internal and external use. She has also done the standardization of various reports, templates, work paper for the purpose of audit. She is also responsible for quality assurance function in audit and assurance services, which technically include review of deliverables, conduct of online review, cold review of audit files, and in charge of implementation of ISQM. She possesses in-depth knowledge of standard of auditing, both domestic and international, quality standards, IFRS, company law, accounting standards, Ind AS, IP-related matters, and other statutes. With this brief, we welcome Padmashree and we once again thank you for accepting our invitation. Padmashree, the stage is yours now.
Thanks, Tejas, and thanks,
Yes.
Yogesh, for the introduction. Thanks again for providing this opportunity. I'll quickly share my screen. Can you please confirm that you can?
It is visible.
It is visible. It is visible.
Yeah, great. Okay. So let me. Yeah. So let me introduce the actually basics. I think we all know, but out of the entire orders, what I have tried to gather over here is that I've made it into two pieces. One is like what is the background of NFRA, which we all know. But then what are the past and procedures? Now procedures, this I have written out of my understanding of the entire stuff. So this is personal view, and this is obviously not the chamber's view or something, or neither ICS view. So I have written this procedures based on like how does it happen, and when we have a review, then what are the things that we need to take care of, either an inspection or an investigation maybe. That is something that is essential for everyone. I thought we'll share with everyone. Then I have bifurcated the order findings into brief two pieces. One is the accounting things that they have found out, and in various orders, and also in auditing. So in the auditing, it includes all the inspection orders as well as the the investigation orders. And there are some other points in the sense that overall other points as to what are the other things that we have to take care of. So that's the flow of the presentation. We all know the origin of NFRA and how it has actually established itself in the past 5 years, if I have to say, because they have started, they are established in 2018, but then actually the working as started from 1819. Now there is NFRA rules that are applicable. All the audit firms are required to submit NFRA Form 2, consisting of whatever is the overall population of audits that they are auditing, which come under the purview of NFRA, and also the overall certain parameters that we have to meet. And then they are fully functional, as well as there are a number of orders, investigations, as well as inspections that are happening as of now. Now, what are the powers associated under the Companies Act or the ministry? Is that they can inspect, that is to upkeep the quality and ensure that things are in place, investigate, pick up cases where public interest is involved, ask for documents, whether in soft form or on hard form. They can levy penalty. They can ask for debarment of the members or the related persons as well. So broadly, these are the powers that we actually see in action as well. The last two things have become quite often because we have seen many cases where there are levying of penalties as well as debarments. Now, in this entire presentation, I have not listed down the penalties or debarments that have happened over the period of time. However, have picked up those instances because of which these things may arise actually, or even an improvement of quality is required. Now, procedure, as I mentioned, this procedure that I have defined over here is completely illustrative in nature. It's not necessary that one has to adhere to this, but this is largely out of understanding that I have put these procedures here. So one is there will be a notice in case of, so there are two pieces. One is inspection, one is investigation. Inspection is an annual activity, so it is actually similar to the PCOB inspections that people who have firms who have registered themselves with PCOB, they also have annual inspections. Now the frequency depends, once in a year, once in 2 years, 3 years, whatever. Now they can choose any of the firms for the purposes of inspection. So when an inspection happens, the procedure is that a notice is sent, and then there is a pre-inspection meeting that happens wherein they understand about the firm, and then there is a overall inspection, that is where they will have the site visit, and then after that they will ask in that way wherein they will ask a lot of information, and also there will be lot of they will choose some files, and then those audit files will also have to be provided for. So first of all, responding to the notice, as soon as anyone receives the notice, it is necessary that responding to the notice has to happen. So any regulator, obviously, because they are audit regulators, it is mandatory to respond. We cannot ignore responding to it. If at all we have any of us have any firm that has received a notice requires more time. If they are traveling, if they are having busy period or anything, they may seek additional time. However, ignoring the notices is not something that will be liked by any of the regulator. Providing information, when they send a inspection or investigation notice, they will always have a list of information that they will require. So carefully go through this actually, against that map the things that are required, whether in inspection or in investigation. That list will be huge because they will not only need the information from only the audit file, but they need a lot of information about the firm, the SQC, the quality control elements, the pillars of SQC, and related information. So there will be a huge amount of information that will be asked. Please make a list of it. It is better that you convert this list into an Excel sheet and then designate people who will be helping you in this entire piece, and also track it so that you have a complete thorough review of it, and then you can actually provide. If there are gray areas, it is advisable to take legal help also, because there are these days lawyers available who actually understand the audit world, and it is easy to take help, and then it is always better to get a independent set of eyes looking at certain things. Okay. So that is the second thing, that we have to gather all the information when they ask for. Third thing is audit producing the documents. So when they say that you will have to produce the documents, there will be based on the list. They will always ask for what are the things that are required. and then accordingly we have to actually gather everything, and then we have to send it across. So when we have to produce the documents, things have to be taken care of in terms of, if it is audit documentation, if it is policies, procedures, proof of any activity that we have done, please do not try to correct it, change it, amend it, anything. Keep the document as is. That is one thing none of the regulator would ever appreciate or like, if the documents are made now or if it is amended now. That is very important. The integrity of the document has to be there. If there are a couple of mistakes, or if there are some things that are not saved, that can be explained. But if the integrity of the document is not preserved, then I think the whole thing goes for a toss. So that is something that everyone will have to take care of, and that is something that we have to be more particular about. So that is the producing of the documents. Now documents can also be produced on hard copy, soft copy. Sometimes NFRA itself gives the firms with a FTP or a secure server on which you can upload the documents as well. Now, if they have any specific inquiries or discussions that they want to do with you, it would be helpful to actually do the discussion along with them, and then ensure that the cooperation with them is appropriately provided, so that later on you don't have a remark that you did not cooperate with us, because cooperation with the regulator is also equally important. Now, as I mentioned, maintaining proper records, not only from now, but it is always necessary. Ensure all audit work papers, the reports, the related documents are systematically maintained and easily accessible. Especially in case of NFRA clients, ensure that we have all the controls with respect to the documents that are available, whether in hard copy or in soft copy, that we maintain everything authentically and then we hand it over when we require. Okay. Timely response, we spoke about that. Take extension if required, and if extension is not possible, if they deny the extension, generally an extension of a couple of weeks is always available, but then please apply for the extension and get the extension, and if an extension is obtained, please try and submit the requisite information within that day. Seeking another extension may not be a good sign of providing the details or cooperating with the regulators. Accuracy, transparency, please check the information. It is possible that some of the information that you're providing may be dated, in the sense that you're providing 2 years old information or a year old information also. So please go through thoroughly, check the accuracy and completeness of the information. If something is left out, do not try to amend anything. Rather inform that these are the things that are outside the file which we want to add it later, but then don't add to the file, give it separately. So you can always make that distinction on the file and explanations when they want additional data. Do not amend any of the file. Ensure that the transparency as well as completeness of the information is duly maintained. Confidentiality, yes, while cooperating with the authorities, we must ensure that we are maintaining client confidentiality also. So one of the important things is that NFRA also gives you the privilege that in case of any order to be published, any inspection report to be published, if you think that this is client confidential data which should not be out in the public domain, you can actually inform them. Ultimate call is taken by them, but then you can inform them that this is confidential data. For example, a pricing information, way of impairment, these things can be sensitive in some cases. So then you have to inform them, and then accordingly they will take that into account to a larger extent, and then they will be able to publish the order or the inspection report, as the case may be. So these are some of the things that you always have to keep in mind. Again, I would like to reiterate that this procedure defined is only illustrative. It's not mandatory to follow, but this is the general practice as such that I have, I'm aware of. Either in the annual inspection, there are two pieces of review. One is thorough review of SQC, along with all the policies, procedures, related documents, and the details and the documents. What do I mean by that? As we know, there are 6 pillars of SQC. One, the leadership and governance, the client acceptance, human resources, monitoring, and so on and so forth. So when we have this SQC, when you have this SQC review, each and every pillar, each and every policy relating to these pillars are seen. Questions are asked on who is the process owner, how does this process run, what are the policies in relation to this, how is the policy implemented, is the policy working or not working, and then supporting documents. Okay, what do I mean by that? For example, client acceptance. Client acceptance, number one, whether you have a policy. Okay, so the standard says that you have to do background checks. How do you do background checks? Okay, do you have a AML policy? Do you have something like a client background check software or something, or how you are checking? If you're checking on Google, is the syntax used on the Google consistent, non-consistent? These kind of questions are generally asked. Do you have a standardized client acceptance form? Do you have something like the client acceptance? Do you have ever any rejections of the client acceptance? So what are the rejections? Can you show us some examples of rejections as well? Because if the system have to be working, then it has to be, if everything is passing through the system, then the system is not working basically. You have to have some rejections as well. So have you maintained the log of rejection? Because that is also required by SQC. So like that, each and every question will be asked, and then a few client acceptances will be picked up to review whether the system is working properly or not, whatever we have explained to them. So then they will pick up few of the samples of the client acceptance. They will review those client acceptance and then look at the policy, SQC1, implementation, everything. And then if there are any comments, then they will put that comments out. Similarly for independence. What are the independence is one of the favorite areas of all the regulators. Client independence, that is conflict of interest, non-audit services. Then third piece, personal independence. How do you maintain? And any offices held by any of the partners or direct or any of the employees in the companies or in other companies by the employees or partners of the firm. So all these matters will be looked into. Independence policy will be seen, declarations will be seen, annual declaration, how do you do the training of declaration of independence, and all these stuff will be seen. Coming to human resources, again, what is the process for joining? What is the process for resigning? What is the process for appraisal? Is quality an element of appraisal? Trainings, how do you train the people? Do you send out certain documents also? If we again talk about the resources, technological resources, are you using technology for the purposes of audit? Then standardization of templates, are you using standard templates? Who makes these standard templates? Who circulates it? How do you know that everyone is getting it? All these questions will be asked, and then samples will be seen of the circulations as well as the repository, as well as how these things are looked into on overall basis. So this is how the review is conducted, and then a few of the audit files will be picked up, and those audit files will again be looked into with respect to SA compliances, SQC compliances, and the firm level policy compliances. And that's how the entire inspection also gets conducted. So all these things that I am saying is already written in the inspection document. Yeah. Now let us switch to key learnings of accounting. Now this is a mix of both orders as well as inspection reports. Topic by topic, I have tried to segregate all the major topics. The focus area of many of the reviews has been actually three focus areas are largely there. One is revenue recognition, impairment, then ICFR of revenue, impairment, and related party. These have been the annual inspection focus areas. But other than that, if you see, there are other focus areas in terms of whenever an investigation also happens. It's obviously with a certain information and hindsight that they already know that there are some problems in some areas. So specifically, those areas have been ECL, loans and advances, provisioning, as well as the again revenue recognition to a certain extent. So there will be these areas that is impairment. So these are kind of favorite areas of all the regulators, and many of the investigations as well as inspections are happening around these areas. Revenue recognition. What are the findings from various orders? So there are so many orders now, and then there are so many inspection documents also. So out of all of those, what I have tried to do is that I have tried to actually pull out whatever is relevant over here, and I have actually made it into area-wise listing. So out of revenue recognition, what are the things that we commonly have? First, appropriate accounting policies. In at least 4 of the investigation orders, it is pointed out that the accounting policy that is written is either adequate or is either inadequate, or it is not matching with the sources of revenue itself. Second important thing is that point of revenue recognition. What is the supporting evaluation for the purposes of point of revenue recognition? This is something that seems to be largely missing. This is not there in most of the cases. In 3 of the cases, this was the thing that was missing. That is, the point of revenue recognition did not match with the policy, and also the point of revenue recognition was not clear. That is, for example, the customer acknowledgement with respect to the sales was not very clearly documented, and how did this get actually into revenue is something that the auditor was not able to explain in that case. Next is adequacy of internal control relating to revenue recognition. One of the things, as I mentioned, revenue recognition ICFR, how is the control environment determined? What is the basis on which the ICFR is being looked into? Now also in terms of the number of controls, key controls, non-key controls, and the risk identification and mapping in this respect. So in 2 to 3 of the orders, you will see that they have commented on the risk identification and classification of risk itself. So so the SA 315 the risk assessment and the classification of risk, that is what is considered as significant risk and why it is not considered as significant risk. If there is a large amount, for example, there are lots of loans and advances in the company, which is, I'm just saying that it is not a non-NBFC, but there are lots of loans and advances. It is there to various components, and then the company has not done a fraud risk evaluation with respect to the same. And then say in future there have been an issue with respect to those loans and advances. So then it is also commented that you have not looked into from this angle, and you have also not looked into from the fraud risk angle. Then the accounting policies followed by previous auditors. This is one of the key learning. Many a times it so happens that people say that this is the policy that is followed by the company. Earlier auditor was doing it, I am doing it, is fine. No, it's not fine. You need to revisit some of the accounting policies. If you feel they are not up to the mark, you have all the liberty to change. No one has held you up that you cannot change. So it is very important to understand if there is previous auditors, accounting policies have been signed by the previous auditors, no one stops you from changing. So there is a point related to this in another order in relation to opening balances testing. Opening balance testing is, if I have to classify, I think most of the places I have heard this comment saying that opening balances are not duly tested the way the standard needs it. So opening balance testing is something that is largely missing in many of the cases, and challenging of the opening accounting policies is also something that is not often seen properly. Then reconciliation of turnover. So there we do always the three-way match, that is we reconcile the turnover along with the GST and along with the overall picture, in the sense that the GL, the ledger, as well as the GST reconciliation is something that we consistently do. If we do not have that, then that is again a question. You cannot have something that is in the GST report. This is also a finding in one of the order, and this is something that is very elementary, if I have to add it that way. Proof of delivery, as per Ind AS 115, actually meeting the criteria of Ind AS 115, the 5-stage approach. that is identification of the contract, evaluation of the terms and conditions, so on and so forth. So the 5 stages of the Ind AS 115, the point of accounting at which these are actually have to be recognized. Again, point of revenue recognition, this is not clearly defined, and this was also not matching with the policy. Material other income balances, they have to be disclosed separately. Schedule 3 also tells us that this has to be done. Ind AS also tells us that this has to be done. However, failure to do this will attract a qualification per se, and if it is not done, then definitely if there is any assessment of these things, then definitely this is something that will be looked into. ECL, expected credit loss, this is impairment, and ECL is something that is all-time favorite of most of the regulator across the globe. So if we talk about the EFR also, this has been one of the focus area across the globe, and from EFR it is coming to all the regulators, and all these regulators have picked up, all the regulators who are members of EFR have always looked into in this. And as we speak, in November 2023, NFRA is also a member of IFR. So they are also looking at the global practices and global, things that are actually affecting the financial statements at large. ECL, evaluation of applicability, identification of areas to Ind AS 109. We all understand that Ind AS 109 is a big sea or ocean. There are so many things that have to be done. And then what is it that actually, what are the areas that are getting affected by Ind AS 109 is a determination in itself, and it's a huge exercise, as we all know. So one of the things over here is that to certain areas in one of the cases, there were a lot of assets to which actually 109 was applicable, but then it was not made applicable, and then the auditor has also not qualified his accounts with respect to this. So evaluation of applicability itself had failed in these cases. Then evaluation of assumptions, this is most important. We can talk about this in terms of accounting also, and we can talk about this in terms of auditing also. Whatever assumptions that are made for these kind of assets, when we have valuation of financial assets, or when we have impairment of non-financial assets, there are lots of assumptions that we have to take into account, and we have to actually evaluate those assumptions also. So the evaluation of assumptions, accounting estimates, SA 540 that we talk about. So SA 540 not being applied in spirit is a larger question here. And then these assumptions, as it is written in the order, said that they have taken the assumption and kept it as is on the file, whatever management has done, but then it is not enough challenged, or it is not actually looked into. For example, when a valuation is happening, the sensitivity analysis that has to be done and that has to be verified for various factors of sensitivity, that was not there in one of the files, and that is what the order has specifically pointed out, that the assumptions are not well tested or well challenged. Use of expert, many a times it so happens that again it is connected both ways. We can talk about it in the auditing as well as accounting balance. When the company uses, so there are two pieces, right? One is use of management expert, use of auditors expert. When management experts are used for any of the complex matters, critical matters, more so in terms of any of these complex financial instruments or something, there what happens is that whatever the experts evaluation is there, number one, evaluation of the experts as per the standard, whether they are competent, they have the knowledge and the skill, and whether they can perform this, that has to be evaluated. Second, again, the data sent to them, the data that comes back from there, and also the assumptions, the work done by them, everything needs to be discussed, challenged, and then only documented. If it is such an area and complex that we are not able to understand as auditors, the standard also gives us the leeway. The standards of auditing also gives us the leeway that we can use an auditor's expert also. Again, if we are using auditor's expert, then the complexity, then the the compatibility, the knowledge, the competence, all that have to be tested, and then what work he has done, that again has to be understood by the audit team, and then it has to be documented. So now when we talk about the audit team, it's all about the engagement team who takes the ultimate responsibility of everything. Needless to say that we may use management experts, we may use IT, GC experts, we may use auditors experts, we may use forensic experts at times. Whoever we use, ultimately the work stops at the engagement team. So this is the way that we have to document. For example, if there is an ITGC, if there is a valuation expert who has done his work, then all we have to do is that not take the valuation report and keep it, but then do the elaborate evaluation of that expert himself, do the work done, do the evaluation of the work done, the assumptions that are required. So there is about assumptions when we talk about, and about the complex areas when we talk about, there is so much that we know, but the only sad part is all that doesn't come on the financial statements. So that's the doesn't come on the audit working paper, I mean to say. So it doesn't come everything on the audit working paper. It has to be documented well so that we have these things appropriate. Questioning mind or the professional skepticism. If we talk about a questioning mind or the professional skepticism, we always have to use this. So there has been a comment in one of the order saying that the auditor has not done the work in terms of he has not questioned it. The professional judgment is not applied and it is not documented. That the professional skepticism is not adequately, documented. Always we have to have this professional skepticism. This obviously comes with experience, and professional skepticism is nothing but asking the question as to why, who, when, and how. So do not accept anything at the face value. Always assess the underlying. Only verifying the arithmetical accuracy, tallying, cross tallying is not going to help. And always question the management bias. To what degree of subjectivity, what degree of complexity is involved, and how is management bias actually ruled out is something very, very important to look at. Conclude on the matters, we have to document well, and we have to challenge all these assumptions and everything that we have spoken about, and then we have to actually document these judgments as well. Everything all said and done, ultimately it should come down to assessing based on the materiality. So not everything can be brushed under the carpet of materiality, but however, everything has to be seen in terms of the materiality as to how material it is, and also look at qualitative as well as quantitative material. If something is qualitatively material, then that also needs to come out very clearly as to what is the qualitative aspect and how we have looked into this. Impairment of non-financial assets. Most of the things that is, expert help for valuation, questioning mind, all that remains the same. Assumption testing, everything remains the same. Something that is very peculiar, unique over here is first assess the indicators of impairment. That is very, very important and the beginning step. Unless we assess the indicators of impairment, so generally this is the common practice that what we say is that, oh, the company is in profits, so I don't need to assess for impairment. No, the document for assessing for indicators of impairment is mandatory to be prepared. Once you prepare the document, then only you will be able to say, oh, I don't need to do the impairment, because then you will prove that there are no indicators of impairment. Without doing that, we cannot conclude that this is not required. That is something that is essential. When we are doing the assessment of indicators as per Ind AS 36, then we have to actually look at the financial indicators, the non-financial indicators. So that is when I'm saying that, we cannot just conclude on the basis of this company is making profit, I don't have to do any impairment. But there may be other factors as stated in the standard, wherein you may have to make a assessment of the non-financial indicators. So this is very necessary. The next thing is assessment of value in use versus market cap versus valuation. So this is always a debate. Once I determine that there is a indicator of impairment, then how do I determine this? So when we are making a decision between these 2 to 3 aspects of what is value in use and what is market cap and what is valuation, we have to choose the correct route and follow the Ind AS step by step. Here what becomes necessary is there is so much that actually we know or we have knowledge that we don't actually document everything. The biggest problem in terms of both this impairment of non-financial asset as well as 109 is there is so much that happens underlying, is that actually not everything gets documented. There is lots of discussion that happens as to what is the valuation, how is the valuation done, how are the assumptions looked into, but the only missing piece is that it is not getting documented the way it has to be. So that gap has to be specifically filled in. So we already spoke about the expert help for valuation, the questioning mind, evaluation of assumption, sensitivity analysis. Ultimately, the conclusion and how is it going to affect the financial statements. That is very important to be documented. Related party transaction. Related party transaction. This has been all the regulators' favorite forever. As we speak, we also know that SEBI has come up with a new portal as well as the detailed disclosure requirement, which is like 60-70 pages, which requires to be fulfilled, and this detailed documentation is required. So as we come to the related party transactions, we have to look at various aspects here. We can look at both the accounting as well as the auditing aspects here. So when we talk about the accounting aspects, it is like how the related party, we will talk about more in terms of the auditing aspects later. But when we look at the accounting aspects, like what is the, in the financial statements, how much is the disclosure that is given, whether all relevant disclosures are provided or not provided, are all the transactions identified, not identified, relationships identified, not identified, whether everything is getting disclosed or not is something that is very important to note. The complete disclosures as per Ind AS 24, including changes, terms and conditions, the moments, everything has to come. Cross-reference to various notes have to be properly given. That is actually goes without saying that cross-reference to various notes have to be properly provided. Ensures also that disclosures as required by the Companies Act. So this is largely again missing section 186, 185, and wherever applicable, the disclosures required by disclosures required under the Companies Act, under the relevant notes. For example, in loans and advances, there is a disclosure that is required to be provided. Under the borrowing also, if there is any borrowing from any of the related party, that needs to be provided. All these things have to be provided appropriately. Okay. Other points. One was, one second. Yeah. Other points in terms of the accounting, one is with respect to non-consolidation of subsidiary or component. This is one thing that is found in, I think, 2 of the orders. And in one order, it resulted into, a very severe action on the company as well as on the auditor here, that how come the subsidiary or the component is not consolidated. It needed consolidation because during the year the company had acquired one of the subsidiaries, one of the companies which has become its subsidiaries, and then at the end of the year the consolidation had not happened, and the subsidiary actually had a significant amount of transactions, losses and stuff like that. So I think that was a severe case as well. Recognition of interest on the NPA. So in one of the NBFCs that were under investigation, so this was one of the point. There was a account that had become NPA. However, interests were recognized, continued to be recognized on the NPA for a certain period. So actually, if it becomes an NPA, then there should be, depending on the RBI norms, IRAC norms, there should be a non-recognition of, interest. Interest recognition has to stop. Or if the system is accruing interest, you have to provide for completely. So that's how it happens. However, in that case, there was continuous recognition of interest on the NPA accounts also. Classification of borrowings. So when we have the borrowings, we have short-term borrowings, long-term borrowings. In the long-term borrowings, then we also classify what is the current portion and what is the non-current portion. That's how we look into the current assets and the non-current asset classification. Because there were certain issues or problems in terms of classification of borrowings. Actually, the disclosure was wrong, and accordingly the current asset current liability ratios were wrong. And then there was issue with respect to debt servicing, which actually led the company into serious problem. And then again, this was a spiraling issue that actually went up to the last level. Then there was evaluation of contingent liabilities, the PPR analysis. So that is a possible, probable, remote analysis that we do of the contingent liabilities. So in this case, what had happened was that many amounts were shown as contingent liabilities, whereas the underlying documents, when looked at, actually were more of the nature that it was either probable or possible. So which would have somewhere warranted a provision in the books of accounts, a certain provision or disclosure specifically in the contingent liability. So there were some balances which were actually not properly identified, and they were actually left out to be disclosed in contingent liability. And then there were some probable or possible items which were shown in contingent liability, but actually they were items which were supposed to be provided for. Writing back of liabilities. If any liabilities are being written off, that is another trigger that the auditor has to look into very much in detail, and they have to look into the supporting as well as the evaluation of why is the liabilities getting written off. Is there a proper policy? Is it actually evaluated and then it is being written back? So major amounts being written back, generally this is the thought that it doesn't harm anyone, or it is not actually a heavy item. So we have, like, it is necessary that we have to come out of these thoughts and then ensure that all the documentation is done. Inappropriate accounting policies, we discussed this in revenue recognition. There were some accounting policies actually that were not matching with the relevant line item, and that was not actually the way it was accounted was different than the accounting policy. So there was a difference in one of the cases in terms of inventory valuation, how it was done vis-a-vis how it is documented. Also, there was this accounting policy issue in terms of 109 as well, and then impairment as well. So these are the things that they will actually look into, and these are the things that we have to be more paying attention to. Disclosure and reporting of charges against asset liabilities, title deeds of immovable properties, all these things are now part of Schedule 3 and also part of the CARO reporting. So when we are doing that CARO reporting and Schedule 3, again, consistency is required. There were reports, or there were mistakes that were pointed out, errors that were pointed out in terms of how it is documented in CARO, how it is reported under CARO, and how it is reported in the Schedule 3 of the financial statement, disclosed on the financial statements. So there cannot be any difference over here, and also the underlying document. The underlying documents have to speak the same language. If something is shown as immovable property and title deed is not available, it has to be disclosed in CARO as well as the reported in CARO as well as disclosed in the financial statements. That was not happening over there. There was certain depreciation that were required to be charged as per certain regulations, but they were not being done because assuming that the asset is not in use or it is idle. But however, as per the company's accounting policy, as per the regulation that is applicable to the company, these were required to be charged. So this was an inconsistency, or the not improper accounting in terms of depreciation. Interest cost considered for inventory valuation, it has to be considered so as only if it is a qualifying asset, and also documentation has to support that as to why this is getting charged to the added to the inventory. Consolidated adjustments. Now this is something that is a age-old item. Actually, all the consolidated adjustments have to be justifiable, traceable, And then intercompany transactions or intragroup transactions, these have to be, so what is basically the thing is that whatever is shown as a debit over here has to be shown as a credit over here correspondingly, and intercompany eliminations, adjustments have to be taken care of properly. There were major flaws in terms of consolidation, and this led to a very severe penal action. So I have just put here the circular with respect to that effective interest rate and effective interest method. This is just for knowledge. I'm not going through this in very much detail, but then this was one of the a very important circulars. That's why I thought we'll put across this. Now we come back to the key learnings in terms of the auditing this thing. So I have classified once again into 3 stages. One is uh, 3 stages of audit other than SQC1. One part I have covered all the SQC pillars, as well as some of the common observations that are there in the SQC observations, issues that you would say, and in the auditing standards classified it into planning and some of the key areas, and then the finalization of the audit, as well as the closure, file assembly, or the closure perspective. When we talk about SQC1, we spoke about the 6 pillars. So with respect to governance and leadership, there has to be clear documentation available with respect to the various roles that are performed, and then if there is inter overlapping roles or things like that, they have to be clearly identifiable and justification that can be provided. Non-audit services, as per local global regulation, as per the whatever the entities are subject to, those are followed, and also prohibited services under 144 should not be provided therein. That is something that has to be always documented, evaluated. So what is required over here is not not something that we have to upfront make a policy or then not do anything, but then what is required is proper evaluation, justification as to what is audit service, what is non-audit service, what is falling under 144, and how do you justify that this is not a prohibited service, and also certain things that actually which code of ethics does not allow, how have you evaluated it. So there may be a application of independence guidance note, code of ethics, section 144, all put together. You will have to completely evaluate these things, and then that is what is required in the given case. Client acceptance ideally have to be performed at the beginning before even accepting the appointment as auditor. So, and that is what is necessary. So before accepting the appointment as auditor, you have to finish the client acceptance. So this has to be demonstrable. The review mechanism has to be demonstrable. And also all the background check, all the other checks that you do through Google, some software, anything has to be properly documented. The syntax that you run have to be consistent. The documents that you actually, the questionnaire or the documents that you use also have to be standard, also have to be consistent when we look at the client acceptance. Human resources, qualified, experienced human resources, who you are using, how you are using, what is their workload of the partners, all these things need some documentation. This is now also part of the AQMM as well. Also including use of technology, how you are by use of technology, how you are increasing the efficiency and quality in the quality systems, that is also necessary to be looked into. Then coming to the EPQR footsteps and the other reviewers or the seniors reviewers. So this is again consistent ask or the question by all the regulators, that whoever has done the work, when he has prepared the work, when someone has reviewed the work, when did the engagement partner look at the work, and when did the EQR looked at the work, and then was there an EQR who could sufficiently challenge the EP on the significant judgments, significant risk areas, and any other areas that is required. So these things have to be documented, irrespective of whether we are having a software, not having a software, doing it in hard copy, whatever it is, we need to have certain forms and questions that are there, and then we also have to demonstrate that EQR and EP has looked at the planning section, all the significant risk areas, all the significant judgment areas, and the completion stage, and the financial statements and notes to accounts. This is necessary to be demonstrated. Obviously, we are doing all this, but then what is not coming out in terms of documentation is that what is the timing, when was it done, and how was it done? So there has to be answers for this, and it has to be demonstrable that all these documents were reviewed and all these documents were actually looked into by the engagement partner as well as the engagement quality control reviewer. The EQR involvement on engagements is something that's actually continuously evolving. If you look at the recent orders, there is a lot of impetus on EQR reviews and giving importance to EQR. EQR is seen as the first level quality control, first step, what do you say, first level safeguard, or the first level quality control reviewer. Everyone else on the file comes later, but EQR is the person who is appointed. Now, how do you appoint EQR? How do you actually say that this is the right person for the purposes of EQR? That is also very essential in terms of how do you document it in the SQC1. So that is also to be looked into. There are practices that are existing, that there are no cross EQRs, there are no things that are actually violating independence and stuff like that, conflict of interest, I mean to say. So all these things have to be taken care of when we are looking at the EQR piece. But then definitely there's a shift, there is a focus on work done by EQR and how it is demonstrable. Is he having enough authority, responsibility, as well as enough capability, industry knowledge to actually challenge the EP? So these are the things that has to be kept in mind. Also, the firm-wide policies, procedures, whatever are made and whatever are circulated, these are to be demonstrable. It cannot be made and kept at one place. It has to be circulated. There has to be demonstration of these things, and then also it has to be consistent across the firm. Now, coming to auditing standards level, I'm not putting up the standard number over here, but largely classifying based on the majority of the findings or the majority of the issues that were there in all of these orders. Materiality in terms of planning, I think materiality was one of the key ones. Adequate documentation with respect to overall and performance materiality. This was not there in two of the cases, so they were not able to understand what is the materiality used, and then there were different materiality used for different areas, so there was no justification written over the file in terms of why these were different. Also, materiality should be based on actual performance of the entity instead of average performance of the entity. This was one of the points. Now, largely, this is something that actually many of us know, that we have an average system also. But then if there is significant decline in the profitability, if there is significant decline in the operations, then we have to go by the actual, materiality, and we cannot take average, because average may be then giving us larger materiality. If we are talking about declining profit, then the materiality will get reduced because the operations may have reduced, the profitability may have reduced. So these factors that we have to adjust is to be adjusted appropriately. So in case, so one of the things that every firm has to have largely is the consultation mechanism, either within the firm or outside the firm. So when they have the consultation mechanism, they can actually encourage more and more consultations with respect to whatever is the methodology that they are using, different benchmarks that they are using. So in one of the reports, it is written that the firm did not have the consultation mechanism, and that's why there was no one to consult. They had some doubts about the benchmarks and the percentages that was to be selected. But since there was no one to actually ask, they went ahead and closed on the basis of that. Risk identification and assessment procedure. So different cases here. One was like risk was not properly identified. There was no mechanism to identify the risk and then classify it into significant risk or the low risk, high risk, low risk, normal risk, and then it was randomly done, but the work done was not matching to that high risk, low risk. So in another case, there was an area that was actually too much problematic, and then that was leading to qualification. However, this was not identified as a significant risk. Also, the presumed risk in case of the rebuttal of the presumed risk of the inherent risk, that also was not there. So there were different permutation combination. Also, the mapping of the control to the risk, that is the RCM that we talk about. So whatever is under the purview of NFRA, it's all listed companies as well as larger companies that are there under the purview. If the expectation is that the the risk and the control has to be mapped, the expectation is realistic because the company should have an RCM in place itself, and if that is not there, then the IFC should get qualified as well. So in this case, what had happened is that the risk and the controls were not adequately mapped, and thereby giving a larger gap that a control is not existing, so the risk becomes more severe. So again, for these things, these were actually said as there were other points also on the file, on the given order. So along with this also became a major point in terms of a lack of documentation. Client acceptance procedure we already spoke about, and one of the things that is also essential under client acceptance procedure is how do you classify your clients into high, low, medium, or whatever risk, more than normal and otherwise. So that is also necessary to know that how do you classify these things. Fraud risk. One of the things that they look into is very much is that how have you looked at fraud risk. So your SA 240 gives you a questionnaire in the appendix that these are the questions that you have to ask. So maybe it is a good idea to send out a questionnaire and get a input. It's not only enough, but then that is one of the steps. Then look at corroborative evidence. Then also do some surprise elements, surprise test in some of the areas. So fraud lies in different areas in different companies. Obviously, this is not standard. So when you have that, then there are different things that can be looked into in different angle. For example, in retail, when cash was mostly given, then cash embezzlements was a common thing. Now when payment is being made, there are QR frauds also that happen. Instead of the company's QR code, the personnel puts up his own QR code, and then there is embezzlement of cash over there. So money over there. In some other type of company, some other type of the FSA, that the financial statement area that is susceptible to fraud may be different in that case. So identifying the area in which fraud risk is most inherent in the given situation is very important to actually identify how these surprise test can be planned, so that element of identification of fraud risk has to be brought onto the file, and it has to be very much visible. In one of the recent orders, there was a question on the timeliness of 143.12 also. So there is a circular on 143.12. As we all know, there's a communication by NFRA on 143.12 on how it is applicable and whether you have to report only the management identified fraud as well as the company identified fraud. So some of the firms have taken a larger view, saying that management identified fraud is also to be reported to central government. Some of the firms say that will go by ICI guidance, wherein it says that only fraud identified by the auditors have to be reported. Now both views exist in the market, but based on NFRA circular, the communication is that you have to document, you have to report both of it. Now, but then both views, both school of thoughts exist here. So there was in the recent order, there was a question on the timing of reporting of the fraud as well. So they said that it is too much delayed. You can't just report fraud for the sake of reporting. The timing is so delayed that everything is closed by now. That is also necessary. So all these things, when we talk about fraud in every area, so in related party, in environment, in loans and advances, everywhere this element of fraud has to be looked into specifically, and this has to be combated at every area, at every line item. IFC internal financial controls or internal controls over financial reporting, if I have to put it that way. Few things that are common, repetitive across orders in whichever areas that they have seen is that the design implementation documentation is inadequate. That is the walkthroughs. D&I walkthrough, the documentation along with supporting is not there. operating effectiveness, samples not taken, not adequately documented, only yes, no written, tick, tick, put across those things. So these are very, very common things. So this is something that, have to be looked into. You have to look at the sample calculator, as we call, from the guidance note of ICFR. For all material business processes, we have to enable issue of opinion. You have to actually, the opinion of the IFC has to get affected if some of the controls fail. Additional work, if we have done, that has to be demonstrable. In 3 orders, so there was actually, the controls did not work. However, no alternate procedure was done. So they determined that, the additional procedure that was to be done is not done, and accordingly, the area is failed, and accordingly, the audit has failed. So that was the conclusion. Evaluation of ITGC. In terms of all the complex environment, there are lots of companies who have SAP, ERP, and all complex systems. But the common observation is that there's no IT expert, and even if the IT expert is there, they are doing some evaluation, they are giving some document. However, the respective audit teams have not looked into those documents, or they have not looked into additional procedures that they have to perform. So in those cases, again, because there was a complex area, because it did not work well, it failed. So there were a lot of things that actually went wrong, and eventually the audit failed. So ITGC documentation is very important, and wherever ITGC has failed, what is the supplement or the additional or the alternate procedure that is done is very important to be noted. In case of any deficiencies that are noted in the ICFR, additional procedures have to be performed without seeing. Evaluation of the effects have to happen, and then all these have to be appropriately documented. What is not happening right now is the documentation flaw, or is the documentation that is not happening. Coming to revenue recognition, on this side of the coin, that is the auditing side of revenue recognition, the sample size testing, once again, for operating effectiveness has to be in line with the risk level. That means, when we look at the guidance note sample calculator, there is when the risk is high, there is a different sample. Risk is low, there is a different sample. So that has to be appropriately taken, and whatever is the risk level, the samples have to be taken accordingly. In one of the cases, the engagement team had not checked the accuracy and correctness of the price details applied to the actual invoices generated with the supporting documents like purchase order, agreement, approval. All these things were not done. So that is again essential. Accounting policies are in line with 115. We already spoke about this. Sampling procedures have to cover all significant revenue streams. It cannot be only for the main revenue. It has to be for all the revenue streams. It is mandatory to have it for all the revenue streams. This side of the related party transaction, audit is more elaborate in terms of related party. Where do we start with? We have to start with the identification of related party. We have to look at the completeness, the source, that is, take the annual report, match with the declarations and GT7 declarations, match with ROC filing, match with annual report, match with every possible source, look at the minutes registers, take a declaration, obtain a management representation. Whatever you do is not enough in terms of related party, but you have to do everything. Verification of transactions, these have to happen wherever it is. Now, verification of things at arm's length price. Now, the question is, there is always a question that floats around, that if I have written in the financial statement that it is at arm's length price, then I have to test it. Otherwise, no. This is the interpretation that is coming out of the standards of auditing. But irrespective, it has to be at arm's length price. And that is what NFRA's expectation is, that wherever there is a related party, you have to test it for arm's length price. If it is not tested, then I think they will have a question on why it is not tested. There is a fraud element, there is this, there is that, and that's why auditors are held responsible over here. Verification of the entire procedure that is followed by the company for identification, as well as the transaction, as well as the agreement, arm's length price. Everything will have to be done in elaborate, and there has to be a documentation in respect to this. and that documentation has to be reflected on the audit file, and all these documents have to be available in the audit file as well. One of the things, many a times it so happens, is that there are lots of minutes and registers that we look into during the limited review, during the last year or whatever, but then actually it stays in the limited review file or in the last year's file. So we have to bring up all these documents and make up all these documents on every year's file. Every year's file has to stand on its own, and every file has to stand on its own. It should not be dependent on any other file or any other additional document. That is actually one of the things that they have stated in two of the orders as well. Compliance with 185 and 186. More spoken the less about these sections. I think there are books written about these sections. There are lots of sessions that have happened dedicatedly on these sections. But yes, this remains as a all-time focus area, and it is not going anywhere. This is here to stay, and then these are the transactions that you will have to evaluate at all from all angles. 185, 186, 181C limits, Section 73 deposits. These are the things that will forever stay as everyone's favorite. So there has to be a continuous evaluation, continuous documentation, looking at all the special resolutions, general resolutions, reportings, calculations that are required under these sections. I'm not getting into too much details of these, but then all these things have to be available on the file. In one of the cases, there were a lot of loans that the company had lent. So there was a question as to how these matters were actually looked into or classified, and then there was some disclosure deficiencies based on which there were severe actions that were taken. Loans and advances. When we talk about loans and advances, again, it's a very wide area. The loans and advances, how it is actually recoverable is the first question. Number one, what is the source? Then second, recoverability. Then third, the utilization. These are the standing questions. And then fourth one, is there any funds diversion? Fifth one, is there any fraud element? All these questions should be answerable. If you look at, I think 2-3 major orders, these are the things that are existing that has actually made the file actually has failed the entire audit. So this is so very important that these things have to be looked into invariably without saying. So I would always summarize into what is the source of the loan, to whom it is given, whether it is falling under any other Companies Act section or under the restrictions, limits, then fraud element, whether we have checked, and then funds diversion, that is end use, utilization, and then the rational and the fraud risk. So these are the things that are not going anywhere, and these are the things that are here to stay. And every time any review happens, these are the things that will be questioned. Impairment, yes, we spoke about the accounting side of the impairment. Now the auditing side of impairment. Are the indicators identified? Are the indicators testing happened? Whether there are financial, non-financial indicators. How are these tested, in the sense that how do you say that there are no financial indicators? How do you say that there are no non-financial indicators? What are the assumptions done by the company? If there are indicators, then okay, something has to be impaired. How do you do the impairment? What are the assumptions? How have you tested these things? Again, the management expert, the auditor's expert, evaluation capability, looking at the assumptions, looking at the data, looking at the completeness. These things are so very important that these things actually take center stage in terms of the any kind of review. Especially in terms of NFRA, in 3 of the cases, the entire investigation, actually there are some 40 pages, 20-25 pages that are written on what are the things that were done in impairment and what are the things that actually is not done in impairment. So these are things that are very, very important to be looked into specifically. Consolidation. What are the things that we look into consolidation? Which are the components that have to be consolidated, and which are the components that are not to be consolidated, and why. If there is any rationale for if there is a rationale for not consolidating certain things, then it is to be documented appropriately. Also, one of the upcoming things or the most debatable things these days is the group audit and SA 600. So what is the expectation of NFRA here is that it cannot be only by way of sending a group audit instruction, receiving it, documenting it, and saying in the other matter paragraph that I have not done the audit, I have relied on it. It's not only about the material, material subsidiary, but it is also about the material transactions in some of the subsidiary or the components. So generally the habit is that you're looking only into the subsidiaries, but it is not that way. SA 600 says that we have to look everything from a overall component perspective. It cannot be from a only subsidiary perspective. So it is very necessary that the focus of NFRA is also here as to when we are actually looking into these subsidiaries, we or the components, we have to look at as to from our group audit perspective, what are the risks from the consolidation perspective, what are the risks and what are the things that we have done. Is there any material balances? Are there any write-offs happening in the subsidiaries or the components? Are there any major issues in the components that we as parent auditor or the consolidated auditor has to be looking into? Gone are the days where the only certain things were sent and then received and then documented. Actual work done needs to be demonstrated, and that's there in one of the order very much in elaborate, around 15 pages written only on why consolidation audit is very important, and looking at the components and looking at all of the stuff that is underlying in the components is very important, so that the risk at the component level, which is actually reflecting on the group level or the parent level, is not getting missed out. Few other points in terms of audit. Going concern. There were, I think, 2 cases in which going concern evaluation by the management was not clearly documented. Going concern as an evaluation, how the company had done the cash flow forecasting, how the company has done the going concern evaluation, these things were not coming out clearly on the file. Also, the assumptions here, the cash flow as well as the assumptions that were taken by the management were as is taken and kept on the file, and NFRA said that there is no further work done on it and there is no supporting, and also the cash flows forecasting was quite dramatic, or they were not actually supported by adequate evidence. So they actually said that the evaluation is not proper. There had to be a proper documentation as well as supporting with respect to all these things. 103 Ind AS 103 business combination. When there is in one of the case, in one of the order, it was the case that there was some contingent consideration in case of business combination. The treatment of that contingent consideration was not in accordance with the requirement of the agreement as well as the Ind AS. So that was a point that was specifically pointed out, saying that this is not done and the accounting is improper. So Ind AS, you cannot say that financial statements are compliant with Ind AS. General point, all the documents that are there on the file need to be appropriately cross-referenced, and it has to be giving references to each other, and wherever necessary. Also, this is mandatory in terms of financial statements. If you have notes, you have to cross-refer all those notes as well. Management override of control. How do you test management of override of control? So one of the things is journal entry testing that everyone does. But journal entry testing, when people do things that are missed out or are documenting the completeness of the journal entry, documenting the overall testing of the journal entry, culling out the various categories. How did you determine that these categories are something that I'm going to test? Other categories I'm not going to test, or So these things are very much necessary, and these things have to be appropriately documented. Obviously, documenting journal entry testing is not possible in hard copy. There are times, because there are n number of journal entries, you may opt for soft copy, but how do you preserve the data? How do you demonstrate that is very important or very critical. So please take care of those things as well. Inventory verification procedures. In one of the orders, the inventories were large amount of inventories were there, but then there was no physical verification, no reconciliation, nothing done. In few of the reports, there was a mention that the audit team had not properly identified who is the TCWG, okay, and then whom they are communicating. Management is considered as TCWG. Management cannot be considered as TCWG. TCWG, board of directors, audit committee members, and people like that. So there has to be a communication with TCWG. It is not with the management only. Letter of representation is necessary. One of the very critical points is that so when an order was passed, before the order was passed, in the explanation, someone in one of the orders, it was written by one of the firm that letter of representation is also obtained from the client. Yes, letter of representation is essential, but that is not the only evidence. So letter of representation obtaining is not considered to be the only mode of evidence. So it is necessary. Not saying it is not there, but then only that will not suffice for the audit work. Opening balances we discussed about. The way opening balances have to be tested, it is not getting tested the way it has to be. It's only tracing from the previous year's TB is happening. Actual opening balance testing is not happening, which has to happen. Write back of any liabilities, we mentioned that appropriate agreement has to be looked into. Again, ECL we spoke about very much in detail. Another factor about accounting accounting receivables, account receivables, is that confirmation. Confirmation has to be direct confirmation. Management confirmation is not confirmation for our purposes. Reliance cannot be placed on it. External confirmations, everything has to be included on the audit file. Control sheet has to be kept. Everything has to be properly documented. Also, in case of accrual of expenses, in particular in case of cost of borrowings under 109, the appropriate accrual has to be done even if it is not paid. This was another general point as such. Now we come to the most important piece of auditing, which is forming opinion as well as reporting. There is always this debate of what is material. So there is a table in SA 705, if you see. So there's a small table which actually says that material pervasive. So if it is material, then it says qualify, but if it is pervasive, then it says adverse opinion or disclaimer of opinion. So this table is so very important to be memorized, that this is the question that often you will see in almost all the investigation orders, saying that this matter is not adequately qualified, it is not enough to qualify, you would have given a disclaimer of opinion, adverse of opinion. So this debate always happens. So documentation of why you are giving a clean opinion, the amount of documentation that is required when you have a clean opinion, I would say 50 times more clear documentation is required when you are giving a qualification. And then every qualification that we make as auditors, there has to be evaluation as to why it is not pervasive, why it is only material. So number one, we start with, there is a error or there is a mistake. Okay. Is the financial statements misstated? Answer is yes or no. Then we go to whether it is material. Then we go to the next question, whether it is pervasive. This evaluation has to happen including all quantitative as well as qualitative factors. When you're talking about pervasive, it has to be quantitative as well as qualitative factors. Lots of fines, lots of penal actions, punitive actions on account of not qualifying, not making an adverse opinion, and even when qualified but not given a adverse opinion. So it can go to that extent. So this is an area where we have to be super careful, and this is a continuous debate that will happen. But obviously audit is what it is at that point in time and the amount of information that you have at that point in time. So everything that you have to gather, put it, and then say why this is pervasive, why this is not pervasive. If you have the slightest doubt of this is going towards pervasive, consult one more person in the firm, consult the EQR. So these are the questions where EQR also becomes very, very important. EQCR also becomes very, very important. Why EQCR did not question that this is material? Why EQCR did not question that this is adverse? This is pervasive. So these are the questions that are posed to EQCR also. So this is very, very important to be looked into. In case deficiency is identified in any of the RCM or any of the controls material weaknesses, please reflect it on IFC. And when you put it on IFC, please consider the impact on the main audit report also. So I always say this, that, read the audit report from the beginning to the end where, I mean, IFC, annexure for auditor's responsibility, and to CARO report, and then read it from back to front again. Any of the clause that is getting impacted, does it have an impact on the main audit report? So let us do that two-way matching at all times so that we are careful and considerate. CAMs and their assessment. Now, why this is a CAM, why this is not an EOM, why this is not a qualification, and why this is a CAM, this thing needs to be always identified. So CAM cannot be a hiding place for the EOM or the qualification. This has to be very clear. Uncorrected misstatements, in one of the order they said that they have to be considered gross of tax and not net of tax, because there was a difference. If they took gross of tax, it was going above performance materiality. If it was net of tax, it was going below performance materiality. So that is very important. You have to consider it gross of tax here. CARO reporting, ensure that you have complete reporting. It matches with the Schedule 3 requirements also. Some of the things are reflecting from there. 185, 186, most important. Please look into loans and advances, 185, 186, 181C, all these things. Please look at when you are doing the CARO reporting. Again, read the report from the start to end and from the end to the start. Disclosures with respect to borrowings with related parties. Give all cross references. Ensure that rate of interest, repayment terms, due date, collateral, everything is mentioned. If these things are not mentioned, then it becomes not an appropriate disclosure where it actually warrants a qualification. So there was one case where these things were not given and qualification is not done. So they said that, auditor has not fulfilled his duty. Very, very important point again, as like qualification versus adverse versus disclaimer. This is again a constant debate on reporting of qualification versus reporting of EOM. Gone are the days that people used to think that I have written it on the report, it is featuring on the report, it is sitting somewhere on the report. Now the 700, 705, 706 put together has a placement for everything. There is a placement for opinion, there is a heading of qualified opinion, there is a basis of qualified opinion, there is a place for MUGC, material uncertainty undergoing concern. There is a place for EOM, there is a place for OM, that is other matter. Anything that you say, there is a place for everything. We cannot just say that it is there on the report and I am done. So it is very, very essential that whenever you are doing EOM, please write prepare a complete memo to evaluate why is it an EOM, is it fitting into the characteristics of EOM, is it really an EOM, or is it a qualification that is actually guised under EOM. This is very essential and this is never ever stopping debate and this will go on. So documentation over there and evaluation over there, correct evaluation over there is absolutely necessary. Again, disclaimed opinion versus EOM versus OM and reporting of a CAM. This we discussed already. So this is again very essential. In case of joint audit, some of the important key risk areas, if you have, document at least the minutes of the meeting, the justifications that were done, some of the audit procedures, and if you have any observations in those areas, then please document those, because joint audit is something that is also essential to demonstrate that you have seen certain things and also you have discussed certain things with the other party. If that is not done, then that may be a non-compliance again. File assembly, archival. File assembly, we have 60 days. Different firms may have different policies, early archivals. But overall, you have 60 days for putting the file together. 2-3 things very essential over here. Once the sign off is done, that is the audit engagement is signed off, minimal changes to the documents should be made. There should not be much changes. Housekeeping notes, if provided, if you have, has to be documented well, or you can prepare one housekeeping note. Housekeeping note is basically why did you change, how did you change, how much did you change, and what is the basis of change. All consultations, whatever you have obtained from internal, external, everything has to be documented. And how the consultation is reached, all the facts, circumstances, technical literature, conclusions, everything has to come on the file. Then in case of hard file, ensure that you maintain the inward outward register and you make an appropriate note in that. And if you have a soft copy documentation, ensure that everything is put across within 60 days and very less changes are made after the sign off. Because obviously, because of the trail on the soft copy, you will be able to see what all is changed after the sign off as well. So this is again very, very essential, and we have to take care of all these things. Few other type of orders that that were very unique. So I put through 2-3 types of orders that were placed, the 2-3 orders that were passed in terms of these very typical matters. One was non-cooperation. Despite several communication, there was one order that was passed ex parte because they sent a notice to the CA firm. He did not reply. They sent again, did not reply. Again 3 times, 4 times, and then they passed a ex parte order. Only he submitted some of the documents at the first instance. Then after the observations, they called the CA firm 3 to 4 times. They did not get any response whatsoever. So they passed an ex parte order, and that order was quite harsh. There was false information in certificate of 80JJAA. So there was this certification under 80JJ, 80JJA, and then the information that was underlying was found out to be false. So this was a certification engagement picked up in larger public interest, and this was again order was quite harsh because it could not be proved that it was backed by adequate supporting. Again, one of the very typical cases, non-consolidation of one of the subsidiaries. That was again a very typical case wherein a very heavy order was passed in this case also. So apart from all these types that I could categorize, these are very, very kind of very different, distinct kind of orders also. So it's not that something that we are doing cannot be seen by someone. Everything is transparent these days, and everyone knows what we are doing, and we are reportable to the various regulators. So we have to be alert, and we have to be looking at all these things continuously. If you want further reading, there is an NFRA website on which you can actually go and read any of the orders, inspection reports, whatever you want. Largely, that's all that I had to summarize. Questions? Any questions?
Padmashree, we have one question in chat box.
Okay.
Whether the inspection will be restricted to assurance assignments of entity covered under Rule 3 or any assurance assignment?
Largely, it is the assurance assignments that actually are picked up for the purposes of inspection. But they ask about all the assurances that you have provided. So it is assurance entities only as covered under the rules, Rule 3.
So
with respect to presentation, I think 3-4 people have asked, but I will send across. Yeah.
So we will request participants to post the queries in Q&A section.
Any questions?
Padmashree, if you're okay, if somebody wants to ask the question in person,
Yeah, you can please unmute.
yeah. So participants can raise the hands. So we have one more question in chat box.
Mm-hmm.
How interest cost can be added in inventory valuation? I think that is not the topic which we would discuss here right now.
No, that was just, I think in one of the orders it was there.
Yes.
So I said that if it is only under certain circumstances. So in that case, what has happened is, I'll just take a minute over here. So in that case, what had happened is that they had actually added this interest cost to the inventory. So the order actually elaborated, they asked a question as to how could you add this to the inventory. So then there was some explanation that was given. So what I had mentioned in the observation is that it cannot be added otherwise unless you have these, you meet the conditions. So that is why I mentioned that, do not, actually it was a negative, that do not add interest cost. It has to be put it that way.
Then we have next question is, please throw some light on the latest High Court order on NAFRA.
So are we referring to the retrospective, rights? Mr. Maru, are we referring to the retrospective inspections? Rights to inspect or investigate into the time when NFRA was not there in existence.
Yeah, I believe that should be the question.
Yeah, so actually that High Court order, if you read, it is split into two pieces. It doesn't say that they cannot investigate. The major question that was asked over there was into two pieces. You can go back and read. The summary is that they cannot order, they cannot act as a body who are investigating, um, and they cannot pass the order also. And then also there is a principle of natural justice of being heard that was not also appropriately given. So they said that in certain cases they can go back and investigate in public interest. However, they have to follow all these principles, and then they have to revisit certain things, and they have to break the body into two pieces, one that will do before 1718 and one that will do currently, whatever inspections or investigations in the current period. So two pieces. So those things are still under a lot of evaluation, and what we hear is there is Supreme Court appeal also by the regulator.
Then we have next question is NAFRA related to NCLT, and in this case, company accountant is also responsible if same prior 2030.
NCLT, you name it, and then yes, one of the larger questions that is looming is there is so much of penal interest, whether it is, so I'm just discussing based on, there are no personal views here or this thing. This is based on articles in the newspaper as well. The disproportionate penalty or the disproportionate, debarment is something very much that everyone is discussing in the professional circles, in the sense the company gets away with a 5 lakh, 10 lakh penalty from maybe SEBI or any of the exchanges. But however, auditor is debarred, and auditor also has a 30, 40 lakh penalty, 50 lakh, 10 crore penalty and all that. So how much is this viable is one of the larger questions that are looming around. So there is no straight answer to this question, but these are the additional questions or schools of thoughts that are looming around. Anything else? Few points very important. Okay, especially about media. Definitely. Okay.
I don't think we have any further questions, Padmashree. So let me
Okay.
take this opportunity to propose a vote of thanks. Friends, we all would agree and appreciate that we could not have the best speaker other than Padmashree with her experience in the firm which she is, and the kind of lecture which she has delivered, and the kind of study on the various NAFRA orders she has done. So, with this brief, I request all the participants to carry out with a loud applause. And we thank you, Padmashree,
Thank you
again
so much.
for you accepting the invitation of the chambers to deliver this lecture. Thank you,
Thank you
everyone.
so much.
And with this, we close the session. Thank you, everyone.
Thanks everyone. Thanks Yogesh, and thanks to CTC.